Good morning, everyone. Today I will be presenting on the statement of financial position. This statement is one of the core financial reports used in accounting and finance. The purpose of this presentation is to explain its structure, components, and importance in business decision making. By the end, you will have a clear understanding of how this statement reflects a company's financial health. Overview of financial statements. Financial statements are formal documents that summarize the financial activities of a business. The three main financial statements are statement of financial position, income statement, cash flow statement. Each statement serves a different purpose. Income statements shows profitability, cash flow shows liquidity movement, statement of financial position show financial position. Together, they provide a complete financial picture of the company. They are prepared according to accounting standards such as the IFRS or GAAP, used by the management, investors, creditors, and regulator for decision making. The statement of financial position is one of the most important report of evaluating financial stability. What is the statement of financial position? The statement of financial position, also known as a balance sheet, show the financial position of the company at a specific date. It answers two key questions. What does the company own? What does the company owe? Unlike the income statement, it is not prepared for a period but for a single point in time. It helps users assess whether a company is financially stable and capable of meeting its obligation. They provide information about company resources and obligation, help users understand the financial strength of organization. Objective of financial statement. The main objective is to present the financial structure of the business clearly. It helps stakeholders understand how resources are financed through debt or equity. It supports decision making for investor, lenders, and management. It ensures transparency and accountability in financial reporting. It also serves as a base for financial analysis and ratio calculation. They provide transparency in financial reporting to support financial analysis and planning. Key element of statement. The statement is built around three key elements: assets, liabilities, equity. These elements are interdependent and linked through accounting equations. Understanding these components is essential to interpret the financial position correctly. Each element provides insight into different aspects of business. These elements form the basis of accounting equations. Asset resources controlled by the company, liabilities, obligations on to external parties, equity, ownership interest of shareholders. Understanding assets. Assets are economic resources owned or controlled by the company. They are expected to generate future benefits such as revenue or cost saving. Example include cash, inventory, machinery, and intellectual property. Assets are essential for running operation and gathering income. They are classified based on how quickly they can be converted into cash. Current assets. Current assets are the short term resources expected to be converted into cash within 1 year. They are crucial for daily business operation and liquidity. Key examples: cash, immediate liquidity, account receivables, money owned by the customer, inventory, good available for sales, efficient management of current asset ensures smooth business operations, short term investments and prepaid expenses. Non current assets. Non current assets are long term resources used over several years. They are not intended for quick resale but for operational use. Examples include buildings and machineries, vehicles, intangible assets like patents and trademarks. These assets support long term productivity and business growth. These assets support the long term growth of the organization, long term investment in other companies. Understanding liabilities. Liabilities are obligations that the company must settle in future. They arises from past transactions such as purchasing goods on credit or taking loan. Settlements usually involve payment of cash or transfer of assets. Liability represent claims against the company by external parties. Liabilities are classified into current and non-current categories. Current liabilities. Current liabilities are short-term obligation due within 1 year. Example include account payables, suppliers, accrued expenses, salaries, utilities, short-term loans. Managing current liabilities is important to maintain liquidity and avoid financial stress. Non-current liabilities. Non-current liabilities are long-term obligation due after 1 year. Example include bank loans, bond payable. These are often used to finance expansion or large investment. Proper management ensure long-term financial stability. Deferred tax liabilities and pension obligation. Shareholders' equity. Equity represents the owner's share in business. It is calculated as a residual interest after deducting liabilities from assets. Key components. Share capital, fund invested by owners, retained earning, accumulated profits. Strong equity position indicate financial strength and sustainability. Calculated after deducting liabilities from total asset, include share capital contributed by the shareholders, may also include reserves and other comprehensive income. The accounting equation. The foundation of statement is the accounting equation. Assets is equal to liabilities plus equities. This equation ensured that the statement always balance. Every financial transaction affect at least two accounts, maintaining equality. For example, taking a loan increase both cash asset and liability. Every transaction recorded affect at least two accounts, maintaining accuracy and integrity of financial records. Importance for investors and creditors. Investors use this statement to evaluate profitability and risk before investing. Creditor analyze whether the company can repay its debt. It helps assesses liquidity, short-term availability and solvency. Long-term ability provide insight into how the company is financed. Creditor evaluate ability of the company to repay the debt, help assess the liquidity and solvency of business, support informed financial decision making. Importance for management. Management use the statement for internal decision making. It help in planning budget and allocating resources efficiently, assist in evaluating financial performance over time, support strategic decisions such as expansion or cost control, help in budgeting and financial planning, assist in evaluating asset valuation, support, help ensure efficient resource management. Financial ratios derive from the statement. Financial ratios are calculated using data from the statement. Example, current ratio. Current ratio divided by current liabilities, debt to liquidity ratio, total liabilities divided by equity. These ratios help analysis liquidity, solvency, and efficiency. They are widely used by analysts and stakeholders. Example structure of the statement. The statement is structured in a clear and logical format. Asset section, liability section, equity section. Assets are usually listed in order of liquidity. The total of assets must always equal liability plus equity. This structure ensures consistency and transparency. Conclusion. The statement of financial position is fundamental financial report. It provides a clear snapshot of a company's financial health. It is essential for investor, creditors and management, help in decision making, planning and financial analysis. Understanding this statement is crucial for everyone in accounting or finance. One of the most fundamental tool in financial reporting. Thank you.